Ever pondered how futures traders magnify their profits without necessarily increasing their investments? The answer lies in one word: leverage. Welcome to the thrilling world of futures trading, where leverage is the key that unlocks the gate to potentially larger profits. What is leverage, you ask? Simply put, it's a financial strategy that allows traders to control larger positions with a smaller amount of capital. Imagine being able to command an army with just a handful of soldiers. That's the power of leverage. But as with all power, it comes with responsibility. Leverage is a tool, not a guaranteed path to riches. While it can magnify your profits, it can also amplify your losses. Picture a seesaw with potential profits on one side and potential losses on the other. The higher the leverage, the more extreme the seesaw's swings. So, leverage is indeed a double-edged sword, amplifying both gains and losses. Now, how does leverage actually work in futures trading? It's actually simpler than it might seem. Let's start with a basic understanding of what a futures contract is. A futures contract is an agreement between two parties to buy or sell an asset at a predetermined price at a specified future date. This transaction can involve anything from commodities like gold or oil to financial instruments such as bonds or currencies. Now, where does leverage come into play? Well, when a trader enters into a futures contract, they don't have to pay the full value of the contract up front. Instead, they only need to put up a fraction of the contract's value, known as the initial margin. This is where the power of leverage lies. Let's illustrate this with an example. Imagine a trader who enters into a futures contract to buy 100 barrels of oil at $60 a barrel, 6 months from now. The total value of this contract would be $6,000. However, with leverage, the trader might only need to put up 10% or $600 as the initial margin. If the price of oil rises to $70 a barrel, the trader can sell the contract for a profit. In this case, the profit would be $1,000, which is a whopping 166% return on the initial investment of $600. But remember, leverage is a double-edged sword. If the price of oil falls to $50 a barrel, the trader would be in a loss position. The loss would be $1,000, which is more than the initial investment. This is the risk of leverage. It can magnify both profits and losses. So, you see, leverage can be a powerful tool in a trader's arsenal, but it comes with significant risks. Before we part ways, let's summarize some crucial pointers about leverage in futures trading. The first and most significant point is that leverage enables traders to control larger positions with less capital. It's like a boost button for your trade, giving you greater power without requiring more resources. The second point, which is equally important, is that leverage can amplify both profits and losses. It's a double-edged sword. If the market swings in your favor, your returns are magnified. But if it goes against you, your losses could be substantial. Thirdly, using leverage requires careful risk management. It's not just about making bigger trades, it's about making smarter trades. And lastly, traders should only use leverage if they fully understand the risks and have a solid trading plan in place. Remember, leverage is not for the faint-hearted. It demands understanding, strategy, and a good dose of courage. Until next time, trade wisely and stay profitable.